Good afternoon to our honorable guests, our faculties, and everyone who joined us for today's webinar. I'm N. Shriya of third year BCom from SVDC. We are really glad to organize the national level webinar on spreadsheet construction of financial statement and understanding by Dr. Monica Ghorkeji. If you have any questions during the presentation, just keep it up. And in the last, we have a Q&A session with our honorable resource person, and you can unmute and you can speak to our and clear all your doubts. Now, I kindly request Dr. Ashalata ma'am, a principal, to inaugural today's webinar.
Thank you, Shriya. Welcome everybody for the national level webinar on the spreadsheet construction of the financial statements and the understanding that we need to have very seriously in the present day world, which has become completely digital. In fact, we from SVDC and on the behalf of Department of Arts and Humanities, I'm very happy, very glad to invite Dr. Monica ma'am for today's national webinar and thank her very sincerely for accepting our request in spite of very busy schedules of hers and many commitments that she has accepted to be the resource person today. Thank you so much, madam, for accepting our invitation and being with us here today. And we are always indebted and greatly responsible for the duties which are given to us by our very honorable chairperson, sir, Honorable Padma Shri Dr. Mohan Babu Garu, and our very revered CEO, Sir Shri Vishnu, sir, for always encouraging us to participate as well as conduct a lot of events in the campus to motivate the students to take up great future ahead. So today's topic, as we have just now, started off looking at it, the spreadsheet construction. So we all know there are thousands and hundreds of Excel formats, like up to the latest Vertex platforms or whatever is available in the present world. We see that the upsurge in the ratio of the students who are taking up all these activities is very minimal. Even when we have huge commerce departments in the college, the students who take up the auditing practices or the general commercial principle or accounting practices are very few. They often go for alternative jobs, which is not at all required. So any company which has got a revenue or an expense or an asset or a liability, or it is completely reporting its financial details as statements, it has got a lot of work to do. And the flow of disclosure which has to be made public or private, it depends on the accounting principles or the quality of the firm's policy of the accounting principles. We have so many standards in the world, from GAAP to FASB, maybe general accounting, accepted accounting principles, or the functional financial accounting standards, whatever boards that we have, maybe they are internationally, like we have International Accounting Standards Board, when we have so many things possibly available which are followed in UK and US most probably, and then they are also applicable internationally. It is necessary for present day students to get updated with a lot of practices which are available. When it comes to the auditing practices also, from the IPR to the Indian Chartered Accountants, they have got 32 standard statements which go on reviews every now and then, they add to it. So they have made all the possible changes parallelly according to the sustainable international levels, and so now it is in the hands of students, because when any company does a cash flow analysis or the funds flow analysis, or the ratios which are analyzed later, it is necessary that the financial statements carry a lot of onus, and the quality or this company's strategy, the entire identity of its economic character depends upon the financial statements which is open into the public. That's the reason why it has lots and lots of importance. So with this particular program, we want to bring into the minds of all our young children, all students on campus and across the country, that learning more about the accounting practices, a lot of nuances which are included in that, and how we can digitally get accepted practices, learn about them, learn about the international standards, and learn from the experts how to construct these statements in a proper way. Maybe constructing a balance sheet is probably the first level of things, but later on when you do it on a spreadsheet in a much better way, or in a much more elaborate way, then we need to get an expert advice. I think Dr. Monica ma'am is going to add to this, and then she's going to deliver a lot of inputs which are going to be of great use to the student fraternity. Once again, I thank all the participants who have joined us today, and thank the management for giving us this opportunity. Congratulations to the team organizing committee members of the Department of Arts and Humanities for making this possible today in spite of their very tight schedules academically as well as other administrative works. Thank you one and all for joining us. God bless all of us.
Thank you, ma'am. Now I request Head of Arts and Humanities, K. Munindra sir, to address the gathering.
Okay, thank you, Sriya. At the outset, I'm very glad to express my indebtedness to Dr. Monica Gorkega. Despite of his some distressing issues that she has committed to conduct this webinar. And for that, me and SVDC, Janiketan Degree College, is more indebted to the when it comes to the our today's title, spreadsheet construction of financial statements and understand. So of course, the financial statements we can construct now in digital era by using many softwares. But anyhow, that mm, key point is here that a software or the media which is available to all easily, that free accessing platform is an Excel. So that is why that construction of financial statements in Excel by using some different functions. I think this session is more helpful for the students and researchers, and of course some faculty fraternity also. So here that Monica Garkegaru have that great experience dealing with these kind of sessions, and she has already did some certification courses on that construction of financial statements in an electronic manner. And also that not even construction of financial statements, whatever the platform you use, but the key aspect here that how we understand, that means how we interpret that analysis to the real business environment, and in turn that kind of analysis will helpful in decision making. So all these things, of course, uh, we have some traditional analysis techniques like ratios, funds flow, cash flow, horizontal and vertical analysis, like that. These kind of techniques are we are having, but how these techniques can be exercised or can be used by in the Excel environment. So like that, and also not only construction, but how we understood and how we interpret of this financial analysis, that a lot of insights we are going to get from this seminar from that eminent personality, that Dr. Monica Garke. Okay, thank you, Monica Garke garu, for accepting and even coming these situations. Really, we indebted to you because we know what the issues are distressing you, even though that you have committed for your promise. So for that, we will indebted to you. Lot. Thank you. Thank you, Steve.
Sir, now I request Sheikh Riaz, sir, lecturer in English, to give us the profile of Dr. Monica Garke, ma'am.
Okay, good afternoon, sir.
Good afternoon.
Is my voice audible, sir?
Yes, yes, your voice is audible.
Yeah, okay, thank you, sir. Okay, welcome to the national webinar on spreadsheet construction of financial statements and understanding. A warm welcome to the Dr. Monica Gorkhe. Thank you, ma'am, for your presence. It's a great privilege to me to read your profile. First of all, I would like to extend my warm greetings to our respected and cool principal, Madam Dr. D. Ashalata Garu, and all the heads of the departments, especially our dynamic head, Dr. K. Munindra sir from the Department of Arts and Humanities, and rest of the all heads of the departments. Good afternoon to everyone. Dr. Monica Gorkhe, Madam, she is currently working as an assistant professor from DYPIMS at Nigri Pardhakan in Pune. She completed her PhD from the financial management in the year 2020. Even though in spite or despite of the all hurdles, successfully she completed the PhD in this year itself from one of the prestigious universities, Savitribai Phule Pune University. She did her dual MBA, both from IB and Finance from the University of Pune in parallelly 2012 and 2013. Apart from the academics, Madam has the vast experience in stock market data analysis using the Excel format and SPSS methods, financial management subjects, tax planning, and advanced Excel methodologies she using in her daily activities. Apart from that, she has the huge amount of teaching experience. She has the 8 years of teaching experience in financial management since she is rendering her services, especially in the both academic and administrative services from 2012. She has the professional experience of Madam is currently working as an assistant professor in Dr. D.Y. Patil Institute of Management Studies since 2017. Earlier, she worked as an assistant professor in Naval Institute of Management Studies from 2012 to 2017, Pune University. She rendered her services as an auditor in Kirtana and Pandit Chartered Accountant from 2011 to 2012. She has the lifetime membership in Indian Accounting Association and also has a membership in the Institute of Company Secretaries of India, simply we called as ICSI. Madam has the keen interest. As the doctorate, she has the very keen interest publishing the research articles in various national and international and the Scopus journals. Madam has the keen interest in research and she published 6 research papers in national and international journals. And she conducted enormously, hugely number of workshops. She conducted 9 workshops and FDPs in her career, and the counting is going on. And she successfully participated in FDPs and workshops, and she attended 38 workshops in her career. Thank you, ma'am.
Thank you, sir.
Yes, Sriya.
Thank you, sir. And now, without any further ado, I request our honorable resource person to commence our webinar today.
Hello. Yeah, thank you so much, Sia. At the outset, I would like to thank the management of Sri Vidyaniketan Degree College, uh, Andhra Pradesh. Then I would like to thank Principal Madam, Ashalata Madam, HOD Sir, Munendra Kayam Sir, and JV Subramanyam Sir for giving me this opportunity to interact with the crowd. And as rightly said, that yes, financial statements are very important, and the owners of the company, the entire performance of the company gets reflected in the financial statements. So understanding the financial statements and the company is very important. So how are we going to do that, and how, after understanding, how are we going to proceed with constructing the financial statement with the help of spreadsheet is very important. So this is going to help us, and today's workshop is going to be more of practical hands-on experience rather than the theory part. So what are we going to do is, our agenda is we'll first start understanding the concepts, and then we'll move ahead with constructing, building the financial statements in spreadsheet. So without further ado, I would share my screen. Okay, I just wanted to know whether my screen is visible and my voice is audible.
Yes, yes.
Yes, ma'am.
Yes, madam. Yeah, it's visible.
Okay, thank you so much. Let's start with it. The process of financial statement, why we are talking about financial statement is very important. When we talk about what is company actually into, what is company doing, what is the market capitalization of the company, so entire thing, the internal activities of the company are going to get reflected in the financial statements, right? So when we talk about the financial statements, first we have to start with reading the financial statement. There is a process of starting, understanding and constructing. So when we start with the financial statement, we start with reading the financial statement. What does reading the financial statement means? Trying to understand what is giving, what the numbers try to say, trying to understand what the change in that number is having its impact on the company's performance. Okay, understanding is how you are trying to interpret the numbers, how you are trying to relate it with the previous years. What is the performance of the company, you will be understood only after understanding how the numbers are impacting the company's performance over a period of time. And at the end of the day, once we have understood how, what are the concepts, what are the different components of the financial statements, we will be able to construct the financial statement, we will be able to forecast it, we will be able to create a module of the future years on the basis of the historical data. So moving ahead, we are first going to start with understanding the three financial statements. So what are the three financial statements? Everyone must be knowing, but let's start with the basic without wasting much of time on it. We will immediately start with our spreadsheet. So there are three important financial statements. There are three important financial statements. First is income statement, second balance sheet, and third is cash flow statements. So let's walk through individual statements so that at the end of the day, we are going to link these three particular statements. With the help of income statement, we'll move ahead with balance sheet and we'll move ahead with cash flow statement. So first important financial statement is our income statement. What does income statement means? Income statement is also called as profit and loss statement. Income statement tells us about how the operational activity of the company is going on. It tells us about what is the revenues, what are the costs which are incurred by the company for producing any kind of goods or rendering any kind of services. When we talk about financial statement, it is said that financial statement communicate you the financial health of the company. It communicates you how the company is carrying out its activities. It tells you about the internal operational activities of the company. So when we talk about income statement tells me about the operating activities, it tells me about the operational activities. It is also called as operational activities. So when we talk about income statement, it is nothing but revenues. Revenues means whatever the sales we have done, then whatever the revenues we have generated by our sales minus our expenses, we are going to get profit or loss for that particular year. Income statement is the statement which is going to reveal the net income of the business. It is going to reveal, it is divided into a few parts. The first part is it tells us about the gross profit. When we talk about the gross profit is calculated by revenues minus cost of goods sold. Why I am talking about this particular format of income statement? When we are going to construct the income statement in spreadsheet, it is very important to understand how the income statement is built. What are the important components of income statement? So let's start individual items and let's discuss about it. So net revenue means whatever sales you have done, minus the refunds, minus whatever the discount you have given, and the net which is left with you is your net revenue. Okay, so net revenue minus we do cost of goods sold. What is cost of goods sold? Cost of goods sold include all the direct expenses which are incurred on that particular product. When we talk about cost of goods sold, it includes your direct material, your expenses, your labor, whatever you have incurred, expended on your production, on your manufacturing activity is your cost of goods sold. When we reduce our cost of goods sold from our revenue, we actually get our gross profit. Gross profit tells us that only and only the profit which is without reducing, prior to reducing the operating expenses, indirect expenses, what is our actual profit left with the company. When we get the gross profit, what we do is we start reducing operating expenses. What does operating expenses means? The best example of operating expenses is your administrative, your selling, your marketing expenses, your general expenses, your research and development expenses. All together we form operating expenses. So once we are done with gross profit, we reduce our operating expenses, and then we come up with uh, earning before interest, tax and depreciation and amortization. So the amount left after your operating expenses, after reducing your operating expenses, is your operating income, which plays a very important role to understand that after reducing all your indirect expenses, what is the amount left with the company. But it is before your interest, tax, depreciation and amortization. After that, we reduce our depreciation, which is only and only on your fixed assets, your interest expenses, whatever loan you have taken, whatever debt is there. So you have to pay certain interest on that. So you reduce that interest, and we get pre-income, which is pre-tax income, that is in earning before tax. And at the end of the day, we reduce the income tax as per the norms, and we get net income. Net income plays a very important role when we talk about how the financial statements are going to help me to understand in the fundamental analysis of the company. Your net income will help you to understand earning per share, EPS. So whatever the net profit is there, net profit is divided into number of things, like you give preference shareholders dividend, you give equity shareholders dividend. So on the basis of net income, you come to know that how much you are going to get the returns from the company if you are going to invest in that company. Okay, so your net income is going to help you to understand your EPS. If earning per share of that particular company is good, if the net profit is good, your earning per share will also be good, and the returns generated over a period of time will be good. Okay, so moving ahead, this is the format as discussed. So what are the things which we should understand, which we should consider when we are going to analyze income statement? So net sales is nothing but our actual sales done, consumption of raw material, what is our employee cost, earning before interest and tax, and your interest rate. What are the points we have to consider these while analyzing your income statements? So when we talk about this, it is said that your net sales, if you're trying to understand the company performance with the help of income statement, operational statement, what you need to do is you have to see over a period of time whether the sales of the company has been increased or not. Okay, so the net sales should be in increasing manner. In case of consumption of raw material, what is interpreted? If the consumption of raw material is more, it means whatever the investment in the raw material was done by the company, that particular investment is getting converted into cash again. So whatever raw material company had purchased, that raw material, the operating cycle is coming back to conversion of the cash. Okay, so more the consumption of raw material means your activities, the manufacturing activities of that company is going good, and the cash generation, the operating cycle is time period of operating cycle is good. Okay, earning before interest and tax, earning before interest and tax will tell me about actual earning of that particular company. We are going to consider before interest and tax. Why it is necessary to consider before interest and tax? Okay, so before interest and tax, when we consider, we come to know that what are the dates. If your earning before interest and tax is more, and after reducing interest and tax is less, it means the company has borrowed more, the company is paying more interest on whatever the company has borrowed. So what we have to understand is, we have to understand two concepts. First is earning before interest and tax. Suppose, taking an example, if the earning before interest and tax is 1 lakh rupees, and the company has borrowed a huge amount and it is paying a huge interest on that particular amount, on that particular loan or debt. So if you are earning before interest and tax is 1 lakh rupees, and you are going to reduce your interest, suppose 30,000 or 50,000, it means that majority of your earned income is going to go for the interest, for which you have what we say, for the debt or for the loan which you have taken. So it is a bad sign if your interest is high. Okay, so we are going to consider two things: earning before interest and tax, and earning after interest and tax. Okay, then your interest level should be less. Yes, your interest should be less over a period of time. It shows that over a period of time company is able to pay off its liability, and over a period of time the when the interest is reducing, whatever the earning left with the company is more as compared to the previous year. Suppose in 2015 the interest was 30,000, then it got reduced to 20,000, 15,000, and 10,000. In this case, in 2015 when it was 30, my profits were reduced by 30. In 2016 when the interest were reduced to 20,000, means my profit now has not been decreased by 30,000 but only 20,000. So this is a good sign that your interest is reducing when you are going to repay your loan. So when we are going to talk about understanding the financial statement and specifically your profit and loss account, you have to talk about, yes, when the dates are low, the borrowed loan is low, your interest amounts are going to be less, and the profit left after your interest is also going to be more. Okay, so moving ahead, yes, your net profit should be high. Your net profit will be distributed among the shareholders who have invested in your shares of the company. They are going to expect good things from you. So when we talk about net profit, if your net profit is good, your dividends, your distribution to the shareholders will be good, as well as your reserves and surplus, your retained earnings are going to be good. Okay, moving ahead, the second important financial statement is your balance sheet. Okay, so when we talk about balance sheet, the balance sheet equation is, what is balance sheet? Balance sheet is nothing but assets and liabilities. What the company owns and what the company owes to others is the balance sheet. It is an annual records of the company. It is said balance sheet is a post-mortem record. Means what? Whatever activities are carried out by the company in particular financial year, at the end of the financial year, that particular activities are presented, are showcased in your financial statements. And important is your assets and liabilities, which talks about what actually the company owns and actually the company owes to the outsiders. The equation says that there is a balance in your sheet, means balance sheet, there is a balance between your assets and your liabilities plus shareholders equity. Moving ahead, assets include, as we all know, that assets are divided into two parts: fixed assets and current assets. Fixed assets are the assets which are for a longer period of time. The investment in that particular asset is huge investment. The returns for that assets are going to be over a period of time. Immediately you are not going to get the returns for that particular investment, like land, building, plant and machinery, your equipments are there, long term investments are there. This is the decision which is going to have its impact on the financial performance of the company over a period of time. If the decision of your capital expenditure, if the decision of your fixed asset goes wrong, it is going to have its negative impact on your financial statements. As we have already said that investment in your fixed asset is going to be huge, the amount is going to be huge, and the returns over a period of time, it is going to take a long period to get back that whatever you have invested. Okay, so when we talk about fixed asset, it is an capital budgeting decision, irreversible decision. So we have to analyze that when we are talking about fixed asset, what are the capital expenditure of the company over a period of time. Okay, it might happen if the company is expanding, so the capital expenditure will be more. Okay, Moving ahead to what is current asset. Current asset is the asset which are going to get converted into cash within 1 year. Uh, when we talk about current asset, it is also said as the current asset is nothing but the operational, whatever we are going to do, like purchase and sale of stock is there, your cash in and out is there, cash inflow, cash outflow, your accounts receivables are there, the receivables which are going to come from your debtors, short-term investments, prepaid expenses, and your marketable securities comes under your current assets. Okay. Moving ahead, same thing applies for your liabilities. Liabilities includes your fixed liabilities, debts, long-term debts are there, whatever for a long period of time, means the repayment of that particular borrowed capital will be more than 1 year. It is called as fixed liability. So over a period of time, what you are going to do is you are going to pay the interest on that particular borrowed capital. When we talk about liabilities and specifically fixed liabilities, what is to be understood? We have what is the point which we have to check? Okay, so we should understand that what are the debts of the company. If the debts of the company are high, it means the liquidity position. It means whenever we talk about liquidity position, whenever we talk about profitability or any other ratios also, this debt and the interest on this debt is going to have its impact on that particular ratios also. When we talk about debt, if over a period of time the debt of the company is increasing, the company is continuously borrowing the loan, so after few years it might happen that company may not be in the position to return back that particular amount which is borrowed, and there can be the company can go for can be insolvent. Okay, so debt, high debt is a negative sign on the financial statements. Long term loan also, when we talk about long term loans, if the amount of long term loans is high, the interest is going to be high, and yes, at the end of the day, the negative impact on your profits, because you are going to give more interest, and whatever left after paying of the interest, the profits will be less. Okay. Current liabilities, when we talk about current liabilities, the liabilities which you have to pay within a year. Okay, the liabilities which we have to pay within a year, like accounts payable are there, your outstanding expenses, short term loans, bank overdraft, whatever the suppliers are there, those who have paid you on those who have delivered the material to you on credit basis, and within a year you have to complete that obligation, that liability is called as your current liability. This is just a basic thing. We are going to see the annual reports of the company as well. So how these are distributed. Okay, we all know that the balance sheet is going to get tallied, means what, your assets are equal to your liabilities. So whatever the component of asset is there, which includes current asset, fixed asset, then your total liabilities include your current liabilities and total liabilities, and at the end of the day we include the common stock, which is also called as equity capital, additional capital which you have done in the company. Retained earnings means the profit which you have kept for the future expansion, for the future expenses, and then your total asset is equal to your total liabilities. Okay, so let's move on. Instead of doing this, what are we going to do is, one by one we are going to see the annual reports as well. Balance sheet, yes, as I told you, debt should be less, reserves and surplus should be more, your cash and bank should be at the increasing trend. Moving ahead, the third important statement is your cash flow statement. What is your cash flow statement? Cash flow statement is the statement which is going to record only and only cash inflow and cash outflow. Only and only cash transaction will get recorded. When we talk about, let's discuss first the accounting methods. There are two types of accounting methods you must be knowing, that one first is mercantile basis and second is received basis. Cash flow statement, when we talk about cash flow statement, it only and only records the items when the cash is actually going outside the company and the cash is actually coming inside the company. Okay. Whereas when we talk about income statement records each and every transaction. But cash flow statement, difference between income statement and cash flow statement is that income statement will record all the transactions. But when we talk about cash flow statement, only and only cash transactions, when actual money is realized, actual money is received, at that time only the that particular amount will get reflected in cash flow statement. Okay. So when we talk about cash flow statement is again divided into two, which is operating activities, your investing activities, and your financing activities. Okay. So cash flow statement, the first activity in cash flow statement is operating activity. What does operating activity means? Operating activity means whatever the company is into, the operational activities of that particular company, the core activities of that company, like purchase and sale of the goods is there, your payments to employees is there, regular tax is there, your payments to suppliers are there, any training given to the employees, any expenses incurred for the employees, your direct, your indirect expenses, everything will come under your operating activities. So when we understand, when we try to read cash flow statement, we will come across first activity, which is operating activity, operational activity. It will tell us about how the operational activity of the company is there. Okay. It will tell us about the actual core activities, whether they are efficiently performed or not. Next is your investing activities. What is investing activities? Investing activities means your capital budgeting activities. You are going to invest in your fixed asset, long-term assets, any kind of securities, marketable shares. You are going to acquire any kind of shares of other companies. You are going to acquire any kind of what we say, small companies. So investing activities will tell us the application of funds, whatever funds we have raised through the financing activities, how we have used that funds, how efficiently and effectively we have used our funds. So the amount, the balance, the numbers of investing activity will tell you your capital budgeting decision. It will tell you how effectively you have invested in marketable securities, any stocks, in bonds. Okay. So whatever you have raised, whatever the sources of funds is there, how the application is done of that particular sources of funds, whatever funds you have, is reflected in your investing activities. Okay. Let's move on with the next activity, which is financing activity. Financing activity is nothing but you have raised your funds. Whenever you start a company, first what you have to do is you have to first jot down that what are the investment which I have to do. What is example, I will have to invest in land, I will have to take building, I will have to invest in construction, I will have to invest in my furniture, which will be taken care by investing activities. When we talk about financing activity, once I come to know that this is my requirement of investment, I will go for raising the funds for that investment. So when we are going to raise the funds, sources of funds will be there. It will get reflected in your cash flow statement, financing activities portion. So your financing activities will include all your debts, your loans, any cash which you have borrowed, any kind of repurchases you have done, then any kind of dividend which you have received from some other companies where you have invested, proceeds received from employees, excising the employee stock option. If you have sold any kind of shares, that will get shares, your debts, that will get reflected in your financing activity. So what is the three important thing in cash flow statement we have to understand is operating activities, investing activities, and financing activities. In financing activities, you are raising the fund. operating activities, your regular daily routine, your core activities, and investing activities is usage of your funds which you have raised in the fixed asset or the long term assets. Okay, let's move on to the construction of financial statement. Before starting with construction of financial statement, first let's take a live example. Let's take annual reports of the company. Let's discuss that, and then we'll move on to construction of the financial statements. I'll share my screen. My PDF was not getting shared. So we have taken the annual reports of Infosys company for 2019-20. Let's first start reading that financial statement, understand the financial statement, and then we'll move on with the construction. Please someone let me know whether my screen is visible.
Yes, ma'am.
Okay, thank you, sir. Sorry for the interruption. The screen was not getting.
Okay, it's okay.
Okay, so as we have taken Infosys, let me first start with the income statement. Okay, so in your annual reports, even if you directly search the word income statement, it will directly take you to that particular. Okay. Let's start discussing one by one with the actual annual reports of Infosys company, so that it will help us to build our own financial statement. Okay, so starting with the we are going to discuss the standalone. So result of our operations means this is an income statement. So we have already discussed that income statement format start with the revenue, that is the net revenue from your operations. And if you see here, net revenue minus your cost of sales, you get gross profit. Once you reduce your operating expenses, that is selling and marketing expenses, I hope this is visible. Okay, so this is the income statement which starts with revenue from operations. We are going to reduce the cost of sales from it, we will get gross profit. After that, we are going to reduce the operating expenses like selling and marketing expenses, general administrative expenses, where we are, after that we are going to get the operating profits. So this is what is getting reflected in Infosys, where 2019 and 2020 31st March the amounts are getting reflected, where the revenue of 2019 was 73,107, which increased in 2020 by 79,047. Okay, moving ahead, after getting operating profit, we start reducing the finance cost. These are the additional things as per the nature of the business, it is going to change. Okay, now finance cost means what? Whatever the interest which we are going to pay is your finance cost. Okay, so we are going to reduce the finance cost from your interest from your operating profit, where we are going to get, after that we'll get the profit before tax. So this is the amount. Profit after tax is the important number, which is the net income in your operational statement, in your income statement, which will play an important role while considering the income statement, that how much the income is there and how much the earning per share of that company will be there as per your net income generated after tax. Okay, so this is the income statement where the tax expenses are there. After tax, non-controlling interest is also there, which is non-controlling interest means the interest which is you cannot what we say, the obligation is compulsory on you, it is mandatory for you to pay off that particular interest. Okay, these are few items which may change according to the nature of that particular business. But when we specifically talk about the format of income statement, it is revenue minus cost of sales, then you get gross profit, minus your operating expenses, you get operating profit. You reduce your financing cost, you reduce your taxes to get profit after tax. Okay, on this basis earning per share is calculated, where you'll come to know if you have invested 1 rupees in that particular company, in one share in that particular company, how much you are going to get returns on that particular one share. Okay, moving ahead, let's talk about the balance sheet components. I'll move on. I'll just scroll down to the balance sheet so that individual items we will be able to discuss. We have to give more time for the construction. This is just a glance that you have to start reading the balance sheet first so that you will come to know what are the components in that particular financial statement. Okay. These are the subsidiary companies. Okay. Let's directly move on to the balance sheet. Okay, this is the balance sheet of the company. I hope this is visible. So as we have discussed the format of balance sheet, your balance sheet includes your assets, which are divided into two: your current asset and non-current asset. Means what your fixed asset. So non-current asset is nothing but your fixed asset. Okay, so moving ahead, these are my non-current asset: property, plant and equipment, right to use. Capital work in progress. What is capital work in progress? Capital work in progress means the investment which you have done, but the work has not yet completed. The project which you have, in which you have invested, but the uh, investment which you have done, the work has not yet been completed, which is called as capital work in progress. Goodwill is nothing but the reputation, the intangible asset which you have. Other intangible assets, your financial assets are there, your investments, your loans, other financial investments, your deferred tax investment. Whenever there is a difference between whatever tax you have calculated and whatever tax the tax department has calculated, there can be this component which is called as deferred tax asset. Okay, so the total of non-current asset and the total of current asset together comes to total asset of that particular company. Moving ahead, the liabilities, which are divided again into two: your current liabilities and non-current liabilities. And after that, we include total equity in that particular liabilities, so that the balance sheet will get the accounting equation, which is assets is equal to liabilities plus your shareholders equity. So this is what the annual reports are reflecting, that these are the asset component and this is the liability component of the balance sheet, and at the end the total equity of that particular company. Okay, we are just taking a glance because we have to construct, so it will take time. So I'll just directly take you to cash flow statement. I just want you people to just take a glance on the annual reports. Just a second. don't know why it is. Okay. So this is our cash flow statement where three components are there. Net cash generated from your operating activities, net cash generated from your investing activities, and net cash generated from your financing activities. So only the cash transaction will get recorded in your cash flow statement. So I have to understand these particular numbers also to understand that what is the liquidity position of the company, because the cash and cash equivalent, everything is going to get reflected in your cash flow statement. Okay. So let's start with construction of your three financial statements. So I have already taken a format. I have already taken a format. In this particular format, what are we going to do is this. Now our work actually starts. First, we have to start reading the financial statement from the annual reports, understand the numbers, what are the components of that particular three financial statements, and then move ahead with constructing your financial statement. Okay. So if you can see here, there is an historical data. On the basis of historical data, you are going to project the future year 5 years data numbers. Okay. So whenever we talk about constructing a financial statement, there should be certain assumptions. On certain assumptions only you will be able to construct the financial statements in this spreadsheet. Okay. So what are we going to do is, with the help of your historical data, what we will do is we will project the future data. Okay. Let's start with the first statement, which is income statement. As already discussed, income statement. Okay. Income statement starts with your revenues, your net revenues. Revenues minus your cost of goods sold, the gross profit will get generated. Okay. Now what we are going to do is, for forecasting, for constructing the building the financial statement for 2017, 18, 19, 20 and 21, I will use the percentage of sales. I will use the historical data. So in this case, in 2015 the revenues were 56,732, and in 2016 59,453. So what is the growth rate? First I'll try to understand the growth rate. The first growth rate will be nil because I don't have the data of 2014. But what about 2016? So what is the difference between these 2 years, whether the revenue has been increased or whether the revenue is has not yet increased? So what are we going to do is, what we will do, current year revenue, that is 2016 year revenue divided by the previous year revenue minus 1, I will come to know that from 2015 to 2016 there was a growth of 4.8% in my actual net revenues. So whatever the sales were there, they increased by 4.8% from 2015 to 2016. Let's now see what is the percentage of the cost which I have incurred with my sales. Okay. So what is the percentage of cost of goods sold to your sales? The best thing is, what you have to do is equal to, you have to divide your cost of goods sold divided by your actual revenues. Cost of goods sold divided by actual revenues will give you the percentage. Means what? In 56,732, 66.2% is your cost. Means whatever the amount you have received, which is 56,732, your cost for producing that particular product is 66.2%. Okay, moving ahead, same thing we are going to do here. Cost of goods sold divided by your revenues, you will come to know that in this 59,453, the cost is 65.4%. Okay, so if we want to cross verify, we can do one thing, that if my revenue is 59,453 and my cost is 65.4%, then my what what is the actual amount of that particular cost of goods sold? The actual amount is the same, yes. So whatever calculation we have done is right. So what, when we talk about financial statement, we first start understanding the historical data, taking the base of it, trying to relate that historical by individual component. That suppose my revenue is 10,000, what is the percentage of cost in that particular 10,000? Same thing we have done here. Gross profit is nothing but it is revenue minus your cost of goods sold. Okay, same thing here we have done. Then what is the percentage of your gross profit to your sales? This is again going to help me to forecast the future 5 years. Okay, so again what I'll do is I'll divide gross profit by the revenues. Okay, now I'll just click on shift and control, shift and left arrow and control R, so that it will automatically get pasted. Okay, whatever the formula was there. So actually I have the operating expenses historical data. I just wanted to know what is, if the revenue is 56,000, 7,209, 201, how much percentage is of 56,000? So again what I'll do is operating expenses divided by revenues, I will get the percentage to sales. Okay, I'll again shift and shift and left arrow and control R, so that the formula will automatically get pasted. Once I'll reduce operating expenses from my gross profit, I'll get earning before interest, tax and depreciation. I'll reduce depreciation, interest expenses. I'll get pre-tax income, which is also called as earning before tax. It is also called as earning before tax. Once I reduce tax, I'll get earning before tax minus your income tax expenses. You get your actual net income. Actual net income, that is earning after tax, which is used for your um, dividends, which is used for your retained earnings. Now this is what is the income statement of historical data. Now our calculation starts over here. How are we going to project our 17, 18, 19, 20 and 21? So as I told you, when we are building any financial statement, as we don't have any data, we have to do certain assumptions. So our first assumption is that what are we going to do is we are going to assume that over a period of time my growth rate in my revenue will be, suppose, 8%. My growth rate will be 8%. I'll just format this so that same thing will be, same formatting will be there for all these cells. So my first assumption in building my financial statement is 5 years my growth rate will be constant, which is 8%. I can even take 7% or 5% or 6%. So what I'll do is I'll just double that and I'll take assumption as 8%. Shift left arrow control R, so that it will get pasted to the other cell as well. So now as I know that the growth rate for this particular revenues is 8%, how are we going to calculate the amount of revenue? Okay, so in this case what are we going to do is we are going to consider your growth rate and your previous revenue. Growth rate and whatever is your previous revenue will be considered. Okay, so is equal to 2016 revenue 2016 revenue into your growth rate, which is 8%. Growth rate is 8%, your plus 1%. Okay, plus 1. So in this case, you will come to know that I am relating this assumption to the previous revenue data. So this 8% is going to help me with the help of historical data of 59,000 to get this amount of revenue. Okay, so what I did is, if I want to do it again, what I have done is 8% I have considered as an assumption. So previous year, which is 2016 revenue, into 8%, which is our assumption, plus 1. Okay, so here I come to know that forecasted growth rate, forecasted rate is 8%, and the amount forecasted will be 64,000. Again, I'll click on shift, left arrow, and control R, so that whatever the formula is there, it will automatically get pasted. Same thing, I'll move ahead with the cost of goods sold. Now I don't have cost of goods sold. So what am I going to do is, I have the previous 2 years data. So what I'll do is, I'll take average. Okay, so is equal to, my next assumption is taking an average of previous 2 years and locking that. How you lock that particular average value? Whatever value is that, you lock that by F4. So when you click on F4, you are locking that particular cells. Okay, I'll complete the parenthesis. Okay, so what is my next assumption? My next assumption is my cost of goods sold will be average of last previous 2 years. So again, what I'll do is, I'll shift, left arrow, control R, so that automatically that particular numbers will get pasted with the formula. Okay, now how are we going to calculate with this particular, how are we going to calculate? Is equal to, same thing we are going to do, whatever is your revenue. Just a second. Okay, I'll format this so that what will happen, whatever is my revenues are there, the revenues are going to help me, because I know that cost of goods sold is 65% of 59,000. In same case, what I'll do is equal to your revenue into your percentage of cost of goods sold. Here I come to know that what is the amount of cost of goods sold. Okay, I'll just drag this, or control and left shift arrow, so automatically that particular figures will get pasted. Now what is gross profit? Your gross profit is your revenues minus your cost of goods sold. So first assumption we have done 8%, second assumption average we have taken, and these two figures we have revenue, we have percentage. So with this help, we have generated our amount of cost of goods sold. So again, shift, left arrow, control R, so that automatically the amounts will get pasted. Now again, percentage, we want to know what is the percentage of gross profit to your revenues. So this will help me for the further calculation. So is equal to your gross profit divided by your total revenues. Okay, I'll just scroll this so that whatever okay, whatever the formula is there, it will again get automatically pasted. Okay, moving ahead, operating expenses. Now again we have to do one assumption regarding operating expenses. What is our assumption is? Our assumption is, while calculating our operating expenses, we are going to again consider the previous data of 2 years, and we will consider the average. So what are we going to consider in future? Also the same expenses will get incurred, and the same percentage will be there as per the revenues. Okay, so again, first, to get this operating expenses amount, to get this particular operating expenses amount, what we have to do is, we have to first do the assumption that average of previous 2 year, I will lock that particular cell and enter. So average is 12.6%. Okay. So I will get this data with the help of the assumption. So my assumption is average. So let's take revenue into your average value. So here you come to know what is your operating expenses. Okay. Now earning before interest, tax and depreciation. How do we calculate earning before interest, tax and depreciation? Is equal to your gross profit minus your operating expenses. You get your earning before interest, tax and depreciation. I will just scroll it so that the formula will automatically get pasted. Okay. Next element is depreciation and interest expenses. Depreciation and interest expenses, we are just going to highlight that we are going to do that particular thing after your PP calculation. After calculating the actual depreciation amount on the fixed asset, we are going to get the depreciation expenses amount. Okay. So as of now, we are going to leave it blank. Interest expenses, as of now, we are again going to leave it blank. The reason behind that is we should calculate debt schedule. After calculating debt schedule, we'll come to know actual amount which we are going to pay for the loans borrowed, for the debts which are there. Okay. So as of now, I'm just highlighting this particular cells. We are going to get this particular amount afterwards. Now, pre-tax income means what? Your earning before interest, tax, depreciation minus your depreciation minus your interest. Okay. This is what the figure which we get. Shift left arrow, control R, automatically the amounts will get pasted. As of now, the same amount has been pasted because depreciation and interest expenses we have not yet entered the amount. Okay. Income tax expenses. Income tax expenses, again we have to do certain assumptions because we are constructing financial statement, right? So in this particular case, we take an assumption of 1500 that our income tax near around 1500 will be there over future 5 years. So again we are going to assume that our income tax will be 1500. Next is your net income. Net income is your earning before tax minus your tax. You get your net income. Just scroll this, shift left arrow and control R. You will automatically get the future amounts. This is what is your income statement, which started with revenue, ended with actual net net income after reducing your cost of goods sold, your operating expenses, your depreciation, interest expenses and tax. Whatever is left in your hand is your net income. Okay. Moving ahead, let's start with our next statement, which is balance sheet. What is balance sheet? Balance sheet is nothing but it is the statement which talks about your current asset, your fixed asset, your current liability, fixed liability and your shareholders equity. Okay. So starting with our current asset, your current assets start with your cash, account receivable, inventories are there, prepaid expenses. Sum of this all, cash, account receivable, inventory and prepaid expenses, is your total current asset. Okay. When I scroll this, I'll just drag this, control R, so that the formula will automatically get pasted. Okay. PPE, plant, whatever your fixed asset is there, your fixed asset will include your land and building, your furniture, your fixtures, your plant and machinery and your equipments. When we go through your financial statements, your annual reports, you will see PPE, plant equipments are there, and the net accumulated depreciation. So the amount is 10,000. I have already taken the historical data so that how to forecast this data with the help of historical data we will see. Okay. Your total asset is your current asset plus your fixed asset comes to your total asset. Again, I'll drag it and control R. Okay. Moving ahead, my current liability portion starts where accounts payable, line of credit, and current maturities of line of credit, three amounts I have. So total of these three amounts, I get total current liabilities. If I see the sum of 5,665, 792, and 500, I get the total current liabilities. Then my non-current liabilities. My non-current liabilities is my fixed liabilities, which is my long-term debt, which is 5,000 and here 4,500. When I add my current liabilities plus my fixed liabilities, I get my total liabilities, which is sum of current and non-current liabilities. This is what is my total liabilities. Okay. Then yes, asset is equal to liabilities plus shareholders equity. So the historical data which I have taken already have the figures of common stock, additional paid in capital, retained earnings. Retained earnings means what? When I have suppose 10,000 profit, I distribute only 3,000 to my shareholders and I keep aside, I reserve 7,000 with me. This is called as retained earnings. The earnings, the profits which you have kept back with you as reserves, as retaining with you for the future expansion or any contingencies or any kind of what we say, any kind of investment, is called as your retained earnings. Okay, this is your total equity. So total liabilities plus total equity means your 11,957 plus your 13,735, you get 25,692. Check. What does check means? It should always come zero. Always come zero means what? Your asset is equal to your liabilities plus your equity shares. Okay, so every time this check will tell you whether your balance sheet is getting balance or not, whether your asset is equal to liabilities or not. So while preparing your balance sheet, what are the assumptions which we have to do? The first assumption, the first, on the basis of the historical data, what we have to do is we have to start with our accounts receivable days. On the basis of accounts receivable days, I will be able to calculate my accounts receivable. On the basis of inventory days, it will help me to calculate my inventory amount. On the basis of accounts payable days assumption, I will again be able to calculate my accounts payable in my current liabilities. So what are we going to do is, my balance sheet starts with my cash. As of now, I am not going to do cash. The reason behind that is it is linked with cash flow statement. Once I'm done with my cash flow statement, I will be able to enter this particular amount. So first, let's start with account receivable days. What is account receivable days? Means what? If I have sold my products, my goods on credit basis, if I've sold my goods on the credit basis and I have given certain credit period to my students, in this particular case, that particular days will be considered as account receivable days. It tells me that how much days it will take to get back whatever the goods are sold on credit basis. So how are we going to do this particular account receivable days? So account receivable is equal to, we will take the account receivable amount for this year 2015, we will go to balance sheet, account receivable divided by, what is account receivable linked with? Account receivable is the amount linked with your revenue. So what I'll do is I will divide current year, your whatever 2015 year account receivable amount divided by your 2015 revenue amount. Here I'll get okay, just a minute. Here I'll get the actual amount of is equal to accounts receivable amount divided by your revenues generated for 2015. Just a second, it is not taking the formula. Accounts receivable divided by your actual revenues. Okay, here itself I'll have to, okay, fine, is equal to your account receivable. Here itself I'll start dividing afterwards. Instead of dividing, here itself I'll start dividing that particular revenue by 365 so that it will not create such kind of problem. Okay. Okay, it takes 50 days to get converted. Again, what I'll do is I'll drag this. It takes 51 days to convert your account receivable into cash. So you have given 50 days to the credit, whatever you have given to the people to whom you have sold your goods. Okay. Moving ahead, same thing will be applied to your inventory days. Inventory days is equal to inventory. I'll get the inventory for my current assets. So inventory divided by inventory is related to my cost of goods sold. So divided by cost of goods sold, here itself what I'll do is I'll divide that by 365. So I'll come to know that how many days, okay, it is taking that inventory to get converted. Again, I'll drag that so that I'll get the future is equal to accounts payable. I'll go to balance sheet, accounts payable 2015 divided by accounts payable is again related to your cost of goods sold divided by your parenthesis your cost of goods sold divided by 365. Why are we doing this? When I am dividing by 365, I come to know one day what is the revenue, or one particular day what is the cost. So if we understand this particular formula, what are we doing is accounts payable divided by your cost of goods sold divided by 365 means if your cost of goods sold for annual year is 37,562, when I divide it by 365 days, I come to know one individual day. Okay. And then again, I divide your account payable, annual account payable by that particular one individual day. Okay. So here I get 55 days. It takes 55 days. So what I did is accounts receivable. I go to current asset, account receivable amount divided by account receivable is linked with your revenue divided by your revenue divided by 365. So one individual day I'll come to know. Okay. Same thing I have done for inventories and accounts payable. Now, what is our assumption? Our assumption for this particular thing is we are again going to take average of previous 2 years, and I am going to lock it. Okay. I'll drag this so that automatically it will get pasted. Again, average of 2 days. I'll freeze it by F4 and again shift left arrow control R. Same thing here. The third assumption for account payable will be is equal to average of previous 2 years, bracket complete, by freezing the both the years, and this is what the period which I get. Okay, now this is going to help me to construct my financial statement for 17, 18, 19, 20 and 21. So forecasting will be done on this particular days. Okay, so let's move on with our first thing. First is your cash. I have done yellow for cash. The reason behind doing yellow for cash is we are going to get this particular amount in after completing entire cash flow statement. Once you complete your entire cash flow statement, at that time only you are going to get this particular amount. It is said that your previous closing balance of cash flow reflects your opening balance of the next year. Okay, now accounts receivable, how you are going to find account receivable, inventory and prepaid expenses. Okay, so as we have the days over here, if you see, we have calculated, we have taken the average, so what are we going to do is, we know the days, right? We know the days, so let's take these days. Just a second. Okay, okay, so we have the days, so it is 51 days it is going to take for the account receivable. So is equal to 51 we will consider, and we are going to, just a second, my is my screen visible now? Hello?
Yes, madam.
Okay, I'm really sorry for this. Okay, so let's start with account receivable. I have the days of account receivable. I'll go, my account receivable is related to my revenue, divided by 365 days, which I have already done. So I'll come to know revenue divided by 365 days. I'll come to know individual one day into 51 days. Okay, let's do this. Again, inventory, what I'll do is equal to, inventory is related to what? Inventory is related to your cost of goods sold. So what I'll do is, I'll go to cost of goods sold, I'll come to income statement, cost of goods sold divided by 365. By dividing this by 365, I'll come to know individual one day into what are the inventory days. Inventory days we have calculated 50, enter. Okay, again, prepaid expenses, let's first drag this, shift left control R. Again we will paste this, shift left control R, so that formula will automatically get pasted. So now prepaid expenses, we don't have any amount of prepaid expenses. So what are we going to do is, we are going to assume that prepaid expenses are suppose 1500. Okay, let's drag this. Instead of 1500 we can take 1200 also. So instead of that, we can, what we can do is, they are constant 1200. Okay, prepaid expenses are constant 1200, that also we can do. So assumption is going to, suppose A person is there, he assumes 1500, B person assumes 1200. The financial statement is going to differ as per the assumption which is done by an individual person. So building your financial model and forecasting completely depends on what are your assumptions and the numbers which you have considered. Okay, moving ahead, the next important thing is your fixed asset. Again, here we are going to highlight this. As of now, we are not going to do this, because this particular amount we are going to get by our debt schedule. Moving ahead, current liabilities, accounts payable, we are going to get the accounts payable amount is equal to, accounts payable is related to your cost of goods sold. So cost of goods sold divided by 365 days. So one day I'll come to know what is the accounts payable, 59. Okay, is equal to cost of goods sold divided by 365 into, okay, this is the amount which gets generated. Shift left, control R. Okay, line of credit and current maturities of long term, these figures also we are going to get after our debt schedule. So three financial statements, again after three financial statement we have to do debt schedule, we have to do depreciation calculation and PPE calculation. So whatever we have highlighted, we are going to get that figures once we complete that particular supporting schedules. Current liabilities is equal to your accounts, sum of your accounts payable, line of credit and current maturities. Okay, I'll just drag this, control R, and I'll paste. Long term dates also I'll do the same. I'll just highlight that. It will not take much time, but I'll just highlight that, so that after my debt schedule I'll come to know the actual amount of long term dates. Okay, so your total liabilities is your current liability plus your long term dates. Okay, the figures will be same as we have not entered long term dates. Okay, let's move on. What are we going to do is, we are going to consider, this is the assumption again. These figures, how we are going to do is, our assumption is that whatever the common stock is there, we are going to keep that common stock constant. Okay, so shift left, control R, so that what will happen, this 15, whatever is the stock, that is going to be common, that is not going to change for the future 5 years. In case of additional capital also, we are going to consider same. Okay, shift control R, shift left, control R. So our assumption is that common stock and additional paid up capital will remain same. What about retained earnings? What are, as I told you, our retained earnings are the earnings which we keep with ourselves. Whenever we are going to pay off our dividend, our decision will be keeping some amount with ourselves, so that what will happen, that in the future whenever I'll require any kind of amount, I will use that particular amount. Okay, so in case of retained earnings include your previous year retained earning plus whatever, what you have to do is, you have to consider your net income. Okay, this is what is your retained earnings. I'll repeat, retained earnings means what? Your previous year, I had balance of 500, suppose previous year. This time I have earned 1000. So your previous year 500 and this year 1000 will be your retained earnings. So same thing we have done over here. What we have done is is equal to your previous year retained earning plus your previous year retained earning plus your net income, and you get your actual retained earnings. When I drag this, shift left, control R, automatically the figures will get inserted and formula will get inserted. So sum, your total equity will be sum of common stock, additional capital and retained earnings. I'll drag this so that the formula will automatically get pasted. What is your total liabilities plus equity? Your total liabilities is 6803 plus your total equity. I'll just again shift left, control R, shift left and control R. Now, as of now, the figures are not going to be zero because there are blank things which we have kept. Here we have not calculated depreciation and interest. We have not calculated cash, PPE, your long-term debts. So this particular difference is there between your assets and liabilities. Now the balance sheet is completed with few of the components which we have not actually calculated. Okay, now we'll move to cash flow statement. One by one we'll have to complete it. So when we talk about cash flow statement, as I told you, cash flow statement start with your net income. It starts adding your operating activities, income from operating activities, income from financing activities, and income from your investing activities. So this will tell me actually what is my cash. So this, whatever I have kept blank, this figure I am going to get from my cash flow statement. Okay, so let's start with cash flow statement. Just a second. Starting with net income, I do have my net income. I'll go to my income statement where I get my net income. So here is my net income. I'll just enter it. I'll just drag this so that what will happen? I'll get this net income I'm getting from my income statement. So what I have done is I have just linked this. Okay. Now, next is your depreciation and amortization. I don't have depreciation. Why we are adding depreciation? Depreciation is a non-cash item. We only reduce the value of the asset. Actual money is not going to go outside. So when we talk about cash flow statement, our cash flow statement is only and only going to talk about your cash activities. As actual cash is not going outside the company, you have to again add your depreciation. Whenever you see any kind of format, you will see that non-cash items are added. Non-cash items are added because you only decrease the value of that particular fixed asset. Cash is physical cash, or the cash is actually not going outside the company. So what we do is, whenever we calculate our actual net income, we add back our depreciation. But as of now, we don't have our depreciation because we are yet to calculate. If you see here, we have kept it blank. We are yet to calculate our depreciation on the basis of our PPE schedule. Okay, let's move on. Amortization, we are going to keep it 0. Amortization is generally on the intangible assets. Okay, now moving ahead, our net income statements have given us the amount which also includes the revenues which include account receivable also. So what are we going to do is, we have to consider the changes in your account receivable, whatever the changes is there in your inventories, and whatever the changes are there in your accounts payable. Working capital means your current asset minus current liabilities. It will tell you that how much the assets are more than the current liabilities. Whatever the your current assets are there, whether they are more than your current liabilities, or whether they are less as per your current liabilities. So when we talk about working capital, difference between current asset and current liabilities, what we have to do is, in our cash flow statement, we are going to only consider the changes, whatever the changes are there in your accounts receivable. So how are we going to calculate the account receivable changes? Account receivable amount, I am going to get that amount in my balance sheet current asset. Okay, so moving ahead, what are we going to do is equal to, whenever we are going to calculate your account receivable changes, previous year. Okay, let's start here only. Here if we see, previous year it was 7,800, and next year it is 8,390. So the figures are saying that it has increased from 7,800 to 8,390. So previous year minus current year will come to know what is the changes in my accounts receivable, is equal to balance sheet previous year minus current year account receivable. I'll come to know that the account receivable has increased from 7,800 to 8,390, means they have increased to 590. When I drag this, automatically the formula will get pasted. Okay, same thing when we are going to talk about inventory. Inventory I'm going to get in my balance sheet current asset. So previous it was 5,000, in 2015, in 2016 it was 5,500. So what I'll do is, again is equal to previous year minus current year. I'll come to know that they have increased by 500. Shift left, Control R. And the formula will automatically get pasted. Same thing applies over accounts payable, where I'll get accounts payable. I'll get accounts payable in my current liabilities. Accounts payable, previously it was 5,665. Then accounts payable has increased to 6,656. So I'll do the same thing. But here what I'll do is, I'll take current year 2016 minus 2015. Okay, and I'll drag this. So this reflects that the accounts payable from 5,665 has been increased to 6,656. Okay, then what is your net cash provided by operating activities? Your net cash provided by operating activities is your net income plus your depreciation plus your account receivable, inventory, and your accounts payable. So your total sum of net income, your depreciation, accounts receivable, inventory, and accounts payable. Okay, this is your net cash provided by your operating activities. What we have done is, first we had taken net income from income statement. Depreciation we have not yet calculated. Amortization, it is 0. Accounts receivable changes we have taken. Previous year account receivable minus current year account receivable. Inventory, again previous year minus current year. In case of accounts payable, what we have done is current year minus previous year. So 2016 accounts payable minus 2015 accounts payable, we get this particular amount, and the total comes to net income plus depreciation, accounts receivable, changes in inventory, changes in accounts payable. Sum of all this, you are going to get net cash provided by operating activities. Moving ahead, our second part of cash flow statement is your cash flow from investing activities. As of now, we have not done capital expenditure. This is, we are going to highlight this. The reason behind that is we are going to do this after our PPE schedule. What is your net cash used in investing activities? Your net cash is nothing but your capital expenditure, purchase of PPE. Okay, I'll just drag this. As of now, it will be 0 because we have not yet inserted any kind of amount in this particular column. Once we include it, automatically this will get changed. Okay, then cash flow from your financing activities. In this particular case, again we are going to highlight this particular sale. Why we are highlighting? We have these supporting schedules which we have to do. Once we do this particular schedule, we will be able to get this particular amount. In case of line of credit and long-term debts, what we can do is we can take this amount from balance sheet. As of now, we do have this particular amount. So what we can do is, instead of keeping it blank, we will immediately take this amount. So line of credit, we can take this amount from, I'll go to balance sheet, line of credit, enter. Long-term debts, I do have long-term debts in my balance sheet. I'll go to balance sheet. Whatever amount I have, I should consider that amount. Okay. Net cash provided in finance is equal to your line of credit plus your long-term debts. Again, shift left. So as of now, it is showing 0. The reason behind that is we have not yet included the amounts over here. Okay. Now, what is your net cash flow? In this particular case, your net income we have calculated. We have calculated your operating activities. We have calculated your investing activities, which is 0. We have not yet taken the PPE schedule. We have not taken the line of credit and long term. Only for that reason, we have kept it blank. Though the what we say, though we have not taken at this particular moment, but we have linked this with the formula. So what is going to happen is, as we have linked it with the formula, whatever the amount we are going to change, automatically it is going to get reflected in your cell in which you have linked with it. Okay, so it is very important that we are linking that particular amount. So as of now, we are done with your cash flow statement of operating, your investing activities, and your financing activities. So these are 3 important things which we should consider now. So what are these? First is net cash flow. Then we have to understand what is the beginning cash flow and the ending cash flow. This ending cash flow balance which we are going to get, we are going to use this to enter here in my current asset. Okay, 2017, 18, 19, 20, these are the amounts which I am going to use. So before that, what I have to do is I have to first consider my net cash flow. How you are going to calculate your net cash flow? Your net cash flow, when you are going to calculate, it is equal to your cash from operating activities plus your cash from investing activities plus your cash from your financing activities. So this is what is your net cash flow. Total of operating financing and investing activities. I'll just drag this so that the amount will automatically get reflected. So 3 amounts we have included in this, and further in the future also these 3 amounts will get inserted as per the formula. Now what does beginning cash amount means? Beginning cash balance means whatever the amount when we open the books of account, what is the balance in my books of accounts. Okay, so where I am going to get this particular amount. Just a second. Is equal to, let's go to your balance sheet, cash flow. Your previous year ending will be your previous year ending balance is your opening balance of the new year. So we are going to consider these particular 2016. I close my books of account. The amount left in my cash is 2750. So my previous closing is my opening for the next year. So for 2017, opening will be closing of 2016, which is 2750. Okay, now let's move on with, I'll just drag this so that formula will automatically get pasted. Okay, now what is ending cash balance? Ending cash balance means what? When I'm going to close my books of account, what will be my cash balance? So is equal to sum of what? Sum of net cash flow plus your beginning cash flow. Okay, enter. Just a second, enter. I'll again drag this. Okay, Control R. So here my cash flow statements get ended where 3 activities I have considered plus the opening balance. So this year I have earned 12,241 and the previous balance was 2,750. So once I am done with this, I come to know that my ending when I close my books of account. So when I close my books of account, I am getting the amount 14,991. Okay. Now next, these 3 statements are done, but there are few items which we have not calculated: depreciation, interest, cash, PPE, line of credit, maturity, and long term. So one by one, let's start calculating this. So our first thing which we have to do is our debt schedule. Through the help of debt schedule, I'll come to know I'll come to know that what is my actual line of credit amount. I'll come to know what is my interest which I am paying. Okay, and what is left with me. So starting with debt schedule. So it says that cash balance at the beginning of the year and end of the last year. Again, same thing we are going to do is equal to, okay, is equal to beginning cash balance, which we have already taken from income statement. I'll just drag this so that formula will get automatically pasted. Cash balance at the beginning, I have cash balance at the beginning over here, D86. I have directly copy pasted. Next is your free cash flow from operational and investing activities. In your beginning cash balance, I add my operating activities and investing activities income generated. So is equal to, I'll go to income statement, operating activities plus investing activities. So here I get cash flow from operating plus investing activities and I do drag this. Okay. Now moving ahead, third is add free cash flow from your financing activity. Why we are doing this? We are doing this to understand what is my actual cash balance left with me and what is the liability of my line of credit. And after paying line of credit, whether cash balance remains with me or still my liability continues. Okay. So only for that reason, I started with this particular amount. I included operating as well as financing activities income, and now I have to include the cash flow generated from your financing activity but before your line of credit. So I'll just include the long term ones. As of now it is nothing, so I'll just take the reference. The reason behind that is whenever I insert any kind of amount there, automatically the changes will be there in this particular cells. Now next is your minimum cash balance. What is your minimum cash balance assumptions? Now what you have to do is, see what I'm doing. First I'm trying to calculate what is my cash balance left with me by accumulating, by considering all the income generated from these activities. Then what I do is, what is the minimum cash balance which I have to keep it aside. Suppose I feel that 3,000 every year I should keep it aside, so that whenever I'll require I can use this 3,000. So my assumption is I will keep 3,000 every year, okay, every year aside, so that what will happen, this 3,000 will be balanced with me whenever I will feel I can use it. Now what is your total cash available from LOC? Total cash available from LOC, total cash available will be is equal to your opening cash balance plus operating and investing cash flow plus your free cash flow from financing activity plus your free cash flow from financing. So opening, operating and investing and financing minus your cash balance. I'm going to reduce this. This means now what is the balance left with me? As of now, the balance left with me is 11,991 in 2017. In case of 2018, 739. So how this is going to impact my line of credit? So what I have to do is, I have to see that whatever my line of credit amount is there, my line of credit amount I can get from balance sheet. Let's take it from balance sheet. My line of credit amount in my balance sheet, let's take in 2015. I do have the line of credit balance sheet. Yes, it is there, 792. Again in 2016 I do have a line of credit amount. I'll take this amount. Okay, so this is my liability and this is my cash with me. What I want is, I want to know that whether whatever cash I have, whether that cash is sufficient to pay off my liability, which is line of credit. So what I do is, I give the formula that maximum, okay, what I want is maximum, I want 0, or maximum give the amount 0, or liability minus cash. Liability minus cash. It is showing 0. Why 0? Means what? I have given the command that if this amount is more than your liability, line of credit is more than your cash available, give me that particular amount, or else give me 0. This 0 means I have 11,991 and my liability is 1,375. Means in 2017 my liability is 0. Again, if I drag this, it is very obvious that it will come 0, because the previous year liability and my cash balance, I will check these three cells. What I'm going to check is this cell I will check and this cell I'll check. Okay, so in this particular two cells, my cash balance is 11,000 and I have to pay line of credit is my liability is 11,000. Means what? In current year, I don't have any liability because I had more cash than whatever my line of credit was there. Okay, now let's move on. I hope I'll just make it clear.
Sriya?
Okay, So moving ahead, now my line of credit amount is over. So I come to know that this is what is cash balance with me and this is what is the liability which I have to give. So totaling of this, I come to know that the line of credit is done. Now, debt schedule I have to do with the help of this particular two terms, which is long-term debt and current portion of long-term debt. Shekhar sir, do you want me to stop or something? Shekhar sir?
Hello,
Okay.
madam.
Yeah, yes, sir.
Still, how long you can take, ma'am?
Sir, only two schedules. I'll wind up, sir. I
Okay,
know that.
you go through.
Yes, sir. Yes, sir.
Okay.
Okay. So total long-term liability and current portion of long-term liability. So I do have this particular figures. So what I need to do is when I'm trying to calculate the future liabilities for long-term debts and long-term current portion, I have to first consider the historical data. Okay. So let's go to balance sheet. Long-term debts, net current balance sheet, current liabilities. I'll take this particular amount. Okay. Current portion of long-term debts. Just a second. Okay. Okay. So I do have long-term debts. I do have net current liabilities. These two amounts I am going to get from my balance sheet. So here, if you see my balance sheet, here current maturities of long-term debts is there, and here long-term debt amount is there. These two things I do have with me. Okay. So what I need to do is I have to take that reference here. Okay. So is equal to enter is equal to again I'll go to balance sheet. I'll just drag this. Okay, once I drag this, what will happen? Automatically the formula will get pasted. Okay. Now, what is the assumptions which we have to do is here when we talk about our long-term debts, we have in 2015 it is 5,000, 2016 it was 4,500. Current portion was 500 and 500. So what are we going to do is as first assumption is that in 2017 the current portion will be same as per the previous year. So what I'll do is I'll just lock it by F4. So 500 assumptions we are going to take that it will remain same for all the future 5 years. So I'll just drag this. Okay. Now rate of interest for long-term debts and rate of interest for line of credit. So here we are going to take the assumption that the rate of interest, when we talk about this, the rate of interest will be suppose 8%. I'll drag this assumption, and line of credit 5%. Okay. So I'll just drag this. So we are considering that in the future, the rate of interest for long-term debts will be 8% and interest rate for line of credit will be 5%. So we do need this particular amount. So here when we calculate for 2017, when we are going to calculate our long-term debts, how we are going to calculate it is equal to previous year minus current year, you get this particular amount. Previous year long-term debt minus the current year whatever you have paid. What does this mean? This means this year my liability was 4,500, out of which 500 I have paid, so left 4,000. Again, when I drag this, if you see that automatically the amount is getting reduced by 500. Means what? My liability was 3,500. I paid 500. The liability became 3,000. By 500, the liability is getting reduced. So next important is, with the help of this particular figures, I'll come to know what is the actual amount of the interest which I have to pay. Okay, so let's see that these are the assumptions which we have done. So how are we going to do the interest calculation? Interest on long-term debts. Interest on long-term debts means these are the amounts which we have to consider. What is the long-term debts? 4,500, 4,500, this is 3,000. So these are the amounts which we have to consider for applying the interest rate. Okay, so interest on long-term debts, how we are going to calculate is equal to average of sum of previous year bracket complete comma sum of current year bracket complete, two brackets complete, into 8%. Okay, here I get, what I have done is I have taken sum of these two average, previous year, current year average I have taken into 8%. I get 380 as my interest on long-term debts. When we talk about interest on the expenses, okay, so in this case we have assumed that interest on expenses will be 5%. Okay, so is equal to average of previous year bracket complete okay, directly will do average of previous year and average of current year line of credit. What will happen? Average of previous year bracket complete instead of average we are going to consider, let's see what we will do is we will take average of line of credit. Instead of that, directly we will take average of, again assumption, let's take average of this into 5%. Okay, so this will help us to get the actual numbers. Okay, as of now it is coming 0 because the previous whatever we have done, we have not inserted any kind of amount over here. Total interest here in long term plus your line of credit. Okay, I'll just drag this so that automatically the formula will get pasted. Now moving ahead, we are done with the interest expenses. These interest expenses, we are going to need this interest expenses over here. If you remember, in our income statement, we have not filled our interest expenses. What we can do is we can link this with the whatever we have calculated. So let's do it. Interest expenses we have to enter here. We have already is equal to, we have got interest expenses. Okay, I'll just drag this so that automatically whatever the figures are there, that will get reflected. Okay, Okay, now what I'll do is I'll remove this so that it will come to normal. We have already inserted the amounts. Let's move on. Let's move on to the PPE schedule. PPE schedule, we do have this particular amounts. We can use that line of credit and all. Okay, let's complete with PP and one by one we will see. So let's start with beginning of PPE schedule. What is PPE schedule? It will tell us that whatever the capital expenditure we have done, what is the depreciation we have on that particular capital expenditure. Okay, so let's what we can do is we do have depreciation amount of the previous year income statement. We do have this amount. So here, if you remember, we have this amount of depreciation income statement for 2015 and 16. We do have the amounts. Okay, so let's move on down. Is equal to, okay, hello, hello.
Madam, carry on, madam.
Sir, in between I feel my hello.
Madam, tell me, madam.
Hello.
Madam, okay, madam.
Yeah, sir. Sorry, sir. Yeah.
Okay.
Some network is fluctuating, I guess. Only for that reason, in between my voice is breaking, I feel. Okay. Starting with the depreciation, I do have the depreciation which is there in my income statement. So what I can do is I can take the historical data. With the help of historical data, I can forecast my 17, 18, 19, 20. Okay. So here depreciation as per the is equal to, I'll go to depreciation. Depreciation divided by revenue. I'll come to know that what is the percentage of depreciation on the revenue. Okay. Now I have got the historical data. As we have done, whenever we have got historical data and percentage, what we can do is we can take an average of that particular thing. So let's take average and F4, so that what will happen, we can freeze that particular cells. Okay, I'll just drag that so that the formula will automatically get pasted. Now we can start calculating our revenues. How we can start calculating our revenues? Here we have the depreciation percentage. Here we have revenues. Means what? From these revenues, from 64,209, we are having 5.59 as depreciation amount. So is equal to, I'll go to revenues, current year revenues, multiplied by whatever percentage I have got. So I have got percentage 5.59. Okay, so here if I drag, what I did is first I took the historical data. On the historical data, I came to know that 5.29 percentage is there in this revenue, which is 56,000. So in this 56,000, depreciation amount is 5.29. So what I did is, with this I have calculated the average, taken an assumption that over a period of time these will be same. So 5.59 percentage depreciation will be same. So 5.59 into your revenue for the current, which is 64,209. Okay. So here I got the depreciation amount, which is 3,058. When I drag this, I come to know that yes, over a period of time, the depreciation amount is automatically increasing. Now, beginning PPE and net accumulated depreciation. I will go to balance sheet. I do have this amount. Balance sheet. Okay, 10,000. I'll take the reference again. 2016 also I can go to balance sheet just to show you. Here is the PP. I do have that. Okay, when I drag this, I come to know that these two amounts I do have. So now, okay, I have not entered the future amounts, so only for that reason it is coming 0. Now here our assumption is, when we talk about capital expenditure, our assumption is capital expenditure will be same. Okay, it will be same for all the years, but every year it will increase by 500, taking an assumption that the capital expenditure will be 3,800, and every year it will increase from 3,800 plus 500, every year by 500 it is going to increase. So I will just drag this so that every year it is going to increase. Now what is the end PPE or net accumulated depreciation? So is equal to your opening plus your capital expenditure minus your depreciation. Okay, as the amounts are not yet, I'll save it. It is getting hanged. Okay, so this is the amount which I get. Okay, moving ahead, what I do is I take this particular thing. Okay, I'll take this and I'll link to wherever the amount I need. I'll go to balance sheet again. Wherever I have kept blank, I have to fill it, right? I'll go to balance sheet is equal to, and I'll select this. Okay, it is not getting pasted. It is 212, 425. Balance sheet. Okay. Let's go to balance sheet and enter this particular amount. The amount is not linking. Just a second. Is equal to. Some error is coming. Okay, let's do one thing. Let's insert this particular amounts first, and then we can insert the last amount. Okay, so we have got the PP and net depreciation amount. One by one, let's start checking which amounts are remaining. In my income statement, depreciation amount is not there. I have calculated my PPE. So what I'll do is I have my depreciation amount here. So in the income statement, I'll go is equal to, I'll go to PPE schedule and I'll enter this particular amount. Okay, when I enter this particular amount, it will give reference and I'll drag, so that what will happen, the formula will automatically get pasted. So my income statement is done. My cash flow statement, from where I am going to get my cash flow balance. Okay, my cash flow balance I am going to get from my cash flow statement ending ones. Okay, now I do have my line of credit and my current maturities, long term debts. So first let's see, let's type the line of credit. Line of credit I can get in this particular. Okay, line of credit, as it is 0, we just need to drag that. Okay, now current maturities of long term debts is equal to, I do have that amount. I'll take this amount, link it, so that automatically the amount will get pasted. Long term dates, I do have long term dates, we have calculated. Let's fill that amount, long term dates. I'll go to again my supporting schedule, long term dates, I do have the amount. I'll give the reference. I'll select that cell, and again that particular amount will get inserted over here. Okay, Here again depreciation amount which we have not yet inserted is equal to depreciation we have calculated over here. Let's give that reference one by one. Let's clear it. Only few more minutes and we'll stop for the day. Okay. Okay. Okay, this is done. Now capital expenditure and PP, the amount was not getting reflected. Let's see. We will start with this. Cash flow from financing activities, we are left with this is equal to as it is 0. After that it was 0. So we have to just scroll it. Next is your long-term debts. We do have the amount of long-term debts. Where is the long-term debts amount? Here is the long-term debts amount. Let's enter that. Okay, so automatically the amounts are getting changed. Okay, next is, sir, my voice is audible. Few more minutes, sir, I'll take, and I'll only two things we have to do and we are done with it. Okay. Accumulated depreciation amount, it is not getting reflected. We need to type one by one that particular amount. Okay, here is my cash balance which I'll do. Just stop sharing. Okay, let's type it instead of wasting time. I'll type it 212,425. Why it is not coming? Now it may happen. Let's see. Okay, now it's done. Amounts have automatically inserted. It was not getting inserted previously. Okay, here also what we can do is we can insert it. Only one amount, even if we do, it will get inserted. Okay, now it is done. Fine with it. Now only cash balance is left. We are done with this cash balance. The previous balance is there. Formula is getting pasted is equal to here we are done with all the activities. Okay, okay. Yes, sir. Hello. Hello.
Madam.
Hello.
Madam.
My Excel sheet is getting hanged actually.
Okay, okay. Finish now?
Hello. Yes, sir. Yes, sir. Someone has raised the hand,
Okay,
so
okay,
we
good.
can. Yeah.
Okay, now, Sia,
Yes, sir.
let's go with the discussion.
Sir.
Sriya,
Yes, sir.
dear participants, thank you one and all. May I hope to receive the Dr. Gorke Madam information about how to construct this spreadsheet by using financial statements. And I think you're all hope to understand and understanding about the today's webinar. Sriya, so go through next schedule.
Yes, sir. Thank you so much, ma'am, for sharing the knowledge. We are really looking forward to use this information practically. Now I request Chandrasekhar sir to start the QA session with our resource person.
Okay, dear participants, is there any queries regarding your doubts? Please clarify your doubts. So the madam is there, is ready. She is ready to clarify your doubts.
Yes, sir. I'll be sharing this with you, sir.
Okay, madam. Thank you.
Yeah.
Dear participants, this is the time to ask your doubts, please, regarding how to construct the spreadsheet by using financial statements. Regarding the queries, feel free to ask.
Go ahead, Sia.
So, if there are no queries, shall I
No
continue?
queries. Okay.
Yeah, you continue.
Okay, Sriya, what is the next schedule? Go through on that.
Now I request Dr. Manohar sir, UG coordinator, to deliver vote of thanks.
Thank you, Sriya. Good afternoon to all. I am Dr. Manohar, UG and PG coordinator of this great institution, Sri Vidyaniketan Degree College. It's my privilege to say vote of thanks to this great national webinar on spreadsheet construction of financial statements and understanding. First of all, we are very much honored to the chairman, Dr. Manchu Mohan Babu Garu, to establish one of the reputed degree college in this Rayalaseema region of Andhra Pradesh state, Sri Vidyaniketan Degree College. I am also very much thankful to revered CEO of Sri Vidyaniketan Educational Trust, Mr. Vishnu Manchu, for his constant support and encouragement to organize this type of national webinars through this platform. Especially, I express my sincere thanks to today's resource person, Dr. Monica Gorke, Madam, for accepting our invitation to deliver her valuable knowledge to all of us. Thank you, Madam. Now it's the time to say heartful thanks to a dynamic, a symbol of activeness, a leader of SVDC family, holding more responsibilities of SVDC, a good speaker who supports a lot with the full of generous, delightful for organizing these webinars, Srimati Dr. D. Ashalata, Madam, Principal of Sri Vidyaniketan Degree College. Thank you, Madam. Thank you once again. On the behalf of all of us, my sincere thanks to today's webinar coordinators, Mr. S. Chandrasekhar and Mr. K. Krishnamraju, who worked a lot for bringing a successful completion of this webinar. Without their commitment, this event would not be a grand success. Now, a man who has a good academic record, good follow-up towards many events in the Department of Arts and Humanities, encouraging the students for their career, a full of support to many events organized by the Department of Arts and Humanities, main pillar of the department. Yes, he is a man of commitment, dedication, determination. Dr. K. Munindra, head of Department of Arts and Humanities. Without his support and continuous follow-up, this event may not be a grand success. Heartful thank you to you, sir. I must thank to technical support team, Mr. K. Munishankar, media coordinator, Dr. S.V. Ravikant, anchoring team, especially Sriya, student volunteers who have given their services to the successful completion of this webinar. My sincere thanks to other head of the departments of Sri Vidyaniketan Degree College, all faculty members of SVDC, members from sister institutions who have participated in this webinar. Last but not the least, I express my sincere thanks to all participants who are highly responded and registered to this national webinar. Your participation, your encouragement gives additional strength for us to organize some more webinars from this department. It was really wonderful session, Madam Monica Gorke, Madam. I hope that all participants have gained a lot of knowledge with full of satisfaction with this national webinar. On the behalf of all participants, once again, I thank to Dr. Monica Gorke, Madam, for enlightening all of us with her valuable information. Personally, I thank to Monica
Thank you so
Gorke,
much, sir.
Madam. I gained the knowledge because I used to prepare the SV Sri Vidyaniketan Degree College budget for the past 5 to 10 years. It was very much useful for me for the coming years for preparing in simple manner by using MS Excel spreadsheet. It was very much helpful to me. Especially I thank to Gorke, Madam. I hope this type of webinars are expecting from the organizers in future also. Thank you one and all for giving this opportunity. Have a nice day. Have a nice day. Over to Sriya.
Thank you, sir. And I would like to thank Dr. Monica Gorke, ma'am, for such a great presentation. It was really a big pleasure for us to have you with us. And all the participants are requested to give feedback through the link which is given in the group. So this concludes the webinar. Thank you all for attending. We hope you have learned and enjoyed this webinar. Thank you, ma'am.
Thank you so much.
Thank you, Shriya. On behalf of the
Thank you.
SPDC and Department of Arts and Humanities, once again, I thank Dr. Monica, ma'am, and wish her all the best in all her future endeavors. Thank you, ma'am.
Thank you
And
so much, ma'am.
best wishes to all the participants and wish you all a very happy and peaceful new year, coming new year 2021. Thank you. God bless all of us.
Thank you, ma'am.
Okay,
Thank you so
Dr.
much.
Monica, thank you
Yes,
so
sir.
much, and we hope that our association will continue in future also.
Yes, sir. Yes, sir. Thank you so much, sir.
Thanks for your warm and heartfelt support.
Thank you
Even
so much, sir, for the opportunity.
yes, even at your some distressing issues, you came to us to stand alone. Thank you.
Thank you, sir.
Okay.
Dr. Monica Garke, madam.
Yes, sir. Hello.
I appreciate you, madam. Madam, once again, I thank you personally. I appreciate you, madam. So to give a valuable subject to our students and our some research college and academicians. So on behalf of my HOD and my principal, madam, I thanks you once again, and I hope
Thank you so
you
much, sir.
to conduct more webinars in future also.
Thank you, sir. Thanks a lot.
Shall we end the session?
Yes, sir. Yeah, sure.
Yes, yes. So good evening, all.
Sriya, conclude.